Welcome to Investing Insights, partnered by Right Property Group. This is your host, Phil Tarrant.
Okay, everyone. How you going? Pleasure to be here for this instalment of Investing Insights with the Right Property Group. I have in the studio with me my regular co-hosts, Victor Kumar and Steve Waters. They're directors at Right Property Group. Gentlemen, how you going?
Good morning. How are you?
Good, Phil.
Victor, how are you going in particular?
I'm going well. I'm not liking the way you're looking at me right now.
Well, he's actually got this, just for our listeners, a little smile
nervous.
comes across his thing, and he's on his back foot. He's in fighting position. But no, that was a genuine sort of how you going. You know, it's we're coming up to the end of the year. It's it's been a good series, a good session of investing insights. I feel like I've learned a lot, and I always enjoy sort of spending time with you guys to talk about property and investing. It was really just how you getting on, mate?
Right. I've just got my guard up, mate.
You have?
That's all.
Okay. And this is interesting because when you start talking about property, people's psychology sometimes gets a bit weird.
Great segue.
I know, it's all right, isn't it? But I was driving in today into work, Victor, and I heard a thing on the radio and it caught my attention. It said that new car sales are down 5%. And the person that was given the commentary spoke about it's because people are worried about their wealth in their properties. So I sort of went, oh, okay, that's pretty interesting. So people aren't refinancing their homes to take a big chunk of cash to buy a new car. Instead, they're sitting there. So there's a little bit of concern in the market right now, I think. And, that was just one of the many touch points I thought, which really showed this different cycle of people's attitude towards security and longevity and wealth in their properties. So it sort of sparked my attention to actually have a chat about this sort of headspace people are in right now. And you guys every single day are dealing with property investors. Are they, Victor, sort of concerned, fearful at the moment, or is there all the good ones sort of just getting on with things?
Look, the good ones are just simply getting on with things. But people that are just listening and, like I said previously, invest via media, they're running scared because there's a lot of negative sentiment in the media. But we need to remember this is part of the cycle. As we come to a peak, it does flatten out and people do stop investing if they're believing in what's in the media. But more importantly, it has a flow-on effect of people spending less money because they're not sure of what's in the future, and they find that let's sit back and wait. Especially now we've got the news of obviously the platform that the political parties are using, which is negative gearing. So that's going to have an impact as well. So it all compounds in. But the reality of it is that for those that have seen this before, in other words, have invested over more than one property cycle, this is business as usual. All we need to do is just simply adjust our strategy to suit the market and suit the market phase that we've got and realign what we're buying and where we're buying.
So we talk about this point in the cycle we are, Steve, and you're probably going to jump into this. What is this cycle and where are we in this cycle right now?
Well, it depends, I think, where you're talking about because, as everybody says, Australia is not one real estate market. There's multiple markets across all different states and areas and even suburbs. But I agree with Victor. It's just business. It's business as usual for the investor. Those that have, as you say, have seen this multiple times, it's nothing new to us. And it's just about adjusting the strategy slightly. And to do that, you need to have first employed or executed a strategy that is able to be adjusted with these little anomalies in the markets and cash flow positions and what have you. Those that perhaps have cornered themselves into a strategy where there is no flexibility are going to see some problems.
Well, if you look at even during the GFC, where the noise in the media was a lot louder than what it is right now, a lot of people stopped buying because they were fearful. And they were really fearful because they couldn't see any clarity in what they were trying to achieve. Whereas if you adjust it in terms of the market and still have that clarity in what you're trying to achieve, the people that actually bought during the GFC and immediately post-GFC, they made a lot of money based on the growth that they had in the property and certainly the cash flow, because the cash flow was a lot higher back then in terms of tiered against the purchase price as well.
Yeah, but to be able to do that, admittedly, they had to have their own house in order to be able to execute as well. Yeah.
So we talk about the psychology of investing, Steve. So this is pretty much what goes, the attitudes, behaviours, habits that you have as an investor and how you can sort of program in your own headspace to be a better property investor. And a word that both of you just spoke about then was clarity. Clarity in your goals, clarity in your strategy, clarity in how you operate your portfolio. For a lot of people, and being experienced investors yourself, but working with experienced investors, what's the habits of those which really crystallise their goals and their strategies and have a really good attitude towards property investment, particularly in tough markets?
They start as they mean to continue, and I think by that I mean that they are always involved, and we've spoken about that many times. It's not a passive vehicle, and if you do approach it with a passive mindset, it's going to run away on you, and you're going to be behind the eight ball, especially as we come into times where perhaps lending's a little tighter. Well, it is. Perhaps the banking system is being reviewed. The market in Sydney and Melbourne has contracted somewhat. Those that are actively involved are able to take care or take advantage of opportunities that present themselves. So I think it's just a matter of being involved all the time.
So is it an understanding and appreciation as an investor that this is just the way it is? Don't allow any noise in the marketplace or media-driven sentiment shifts to cloud your approach to property investing. Is that what you're saying?
Not that it clouds the approach, because consumer sentiment and shifts in trends and what have you do have a direct result on property prices somewhat. Those that are always going to invest are always going to invest. And if property's their vehicle, they'll continue to use it with some, a little bit of diversification, to be fair. But I think it's just, once again, it's about having crossing the T's, dotting the I's, and having everything in order, because whilst everybody needs a roof over their head, and that's been a well-worn cliche, it's the truth. Accommodation is one of those biggest priorities for all of us.
What does it mean, Victor, to have your house in order, to dot the I's and cross the T's? What does that actually mean to capitalise on this marketplace? And that's what we're talking about.
Yeah, absolutely. We are. The first thing we need to look at is what's panning out in the finance market. So how can we look after our borrowing capacity? Because if we're not able to borrow money, obviously it slows our investing down pretty significantly. So we're looking at simple things such as not getting into these consumer loans, such as credit cards or personal loans. Now is not probably the right time to buy or upgrade your car.
Or the hire purchase.
The hire purchase, absolutely. Yeah. The greatest scourge, I think, in terms of finance is the pay later.
It's even like this afterpay thing
that's
now.
It.
And people are like loving it, but essentially
it's huge.
It's massive, but it's debt, right? And it's not going to look good against a potential application for a loan, right?
No.
Is that appearing yet? Afterpay stuff?
It is. And what we're finding with a lot of our clients is that, and also through brokers, is that the lenders are actually querying small transactions, such as even a $50 purchase at Grace Brothers or one of the
Grace Brothers. Do they even exist anymore?
Yeah, it's a great shop.
Yeah.
Where?
You leave Grace Brothers alone. It's called Myer.
It's called Myer.
Yeah, they're doing well.
Yeah. And the reason why they're querying that is that most of these stores have store cards that they can purchase, right? So and they are essentially branded credit cards. So they're actually querying all of these things. So you have to be mindful of not taking on these offers of interest-free periods and whatnot, especially getting into Christmas now.
Yeah.
I think we need to be really vigilant about it. And then the other thing that we need to be looking at is obviously don't keep doing the same thing and expect a different result. So we need to obviously change how we're investing, where we're investing, and what level we're buying it. So if it is that we can only qualify for say a loan of 250,000, maybe it is time to sit it out and until the finance eases out, because this has gone a whole cycle. Just post GFC, finance was just as tight as it is right now, except there was different levers being pulled in terms of interest rates and so forth. Right, whereas right now it's more the qualification of the loan that they're looking at in terms of how they look at your borrowing capacity in terms of the household expenditure measure, the HEM, where previously the bank used to look at it and say, okay, you know what, you're nominating a figure that is in line with HEM. Now, most lenders are looking at your actual expenditure, to the point where I had one of my friends who got his loan knocked back because the credit officer actually added up all of his credit card expenditure and said, actually, no, you're spending this much, not what you've declared on the application itself.
But is that a bad thing? Like, it is for your friend, I suppose. But I think, from a psychological point of view, this is creating better habits.
Absolutely, it is
for the investor.
Absolutely.
So they're not taking the credit cards; they're not using them. And we all know that credit cards is just another form of slavery. Really, you shouldn't be spending what you already don't don't have. And if you're going to approach investing as a business, well, you're always looking at the bottom line and you're looking at your cash flow scenarios. And you're certainly not taking on 24% borrowed money just to get by.
Yeah.
Well, it's okay if you clear your credit card at the end of the month, but this is the business that credit card providers are in, that you don't clear your money. You
Odds
keep a
are you
balance on
won't.
it. Yeah.
Yeah.
I
And
always clear mine every payday.
I don't have
mine.
one. I refuse to have one.
You don't have a credit
I
card?
don't have a credit card. I use a debit Visa, but I don't have a credit card. But even still, even if you do clear yours out and you scrape it clean at the end of the month, the banks are still looking at as debt incurred.
Yeah.
Because you can use it and that affects the serviceability. So from a borrowing point of view, maybe you've got to cancel a few credit cards.
Okay, well, let's use this in the 5 habits of highly successful property investors in this market. Number 1, they have a true understanding of their exposure to debt outside of their home loan, so credit cards, store cards, and they try and minimise their exposure as much as possible. That's a fair point, number 1?
Yep, number 1.
What's number 2?
Cash flow management.
Okay.
So it's knowing what your debt exposure is one thing, but being able to handle and manage your cash flow and forecast is equally as important.
Okay. Victor, 3?
Certainly the investing strategy in itself. So, not just doing buy and hold. So in markets like this, really, you need to be looking at it from 2 viewpoints. If you're buying, say, in Sydney and the market is absolutely slowing down, you need to change the property that you're buying to something that you can manufacture the equity to protect your deposit. And the other side of it would be that maybe it is time to look at some different asset classes, such as not just house and land, maybe looking at commercial as an example to offset what you've already got.
Okay. Steve, you got 4 for me? Number 4?
No, it's your turn. We're going around the table.
Oh, are we now? Okay, 4, you'd be thinking about the future, I think. Just don't buy in today's market. I'd be looking to what you are buying in tomorrow's market. And that's where my headspace is right now. And, I'm not proactively buying at the moment. I'm cashing up because I think there's some great opportunities coming online. So you need to understand where
Based
those
on your
locations are. Based on my exposure.
Correct.
Absolutely.
I think the 5th one is to have the money before you need it. So, free up all of your equity because the lending could become a lot tighter down the track. Certainly, if I draw my experience back from the GFC, lenders were actually reducing the limits on the lines of credits. So if you have a large line of credit or lines of credit, it may be worthwhile re-looking at how you're doing your banking. Right? Do you change that into offset accounts? Speak to your accountant, obviously. Yeah. Do you change it into offset accounts so that the bank can't technically touch it because it's sitting in a savings account? Whereas as lending gets tighter and funding gets more scarcer for the banks, they're going to look into their books and say, okay, what money can I free up? And if you haven't been using, let's say you had a $500,000 line of credit and you've only been using $30,000, $40,000 of it and the rest is just sitting there not doing anything. From previous experience, the bank would reduce it to 30% of its limit because you're not using it, so they can free up that money to lend out again. And I would say that we will start seeing some of this in the near future.
So we're talking about the psychology of investing, Steve, and we just went through some really good habits there of people in this particular market, how they can excel in investing. Psychology is a lot of it's based around your attitude and how your attitude changes based on the information you have or the feelings or sentiments that you get. People with a good attitude to investing, to me, would mean that irrespective of what's going on, that they probably remain as positive as possible and look for the good rather than the bad. Do you see that a lot in the people that you work with?
All the time.
Yeah.
It especially perhaps, if I can use the term sophisticated investors, so those that have been around for a couple of cycles, they know what they know, and this is their wealth vehicle, and so they know everything about it, and they're on top of their numbers and their forecasting and their balance sheet and what have you, so that all the noise and all the media, whether it be positive or negative, they still approach it in the same way, and that is finding the well-located asset that's going to perform well over a number of years, and that's actually a key point as well, because they're not looking at a short-term fix, and the problem that we see, just generally speaking, with psychology is really around the Sydney and Melbourne market over the last 5 years, where there's been such huge wins that people that perhaps haven't been around for a while think that that's the new norm, or that is the norm because they know no different. And so that when we see these contractions in price by somewhere between 5 to 20% across the Sydney market, that starts to play with their psyche. And rather than perhaps look at a long-term point of view and look at a 15, 20-year time frame, they're out. They just want to cash the loss or cash the win and get out and move on.
I think it's really important to understand that if you're looking at data in a small snapshot, it can be really deceiving, right? So when you say that the price has come back 20%, we should not ignore the fact that it's actually gone up 75% to begin with.
Yeah, let's be real.
Right?
Yeah.
So we've lost 20%. And if you haven't over leveraged, this is really good because you now gained pretty much 50% of what you've bought. Yes, you've given some back because it was 75 initially and you've given back 20 odd percent. So you've gained money. And a lot of these articles that are floating around, a lot of this commentary that's floating around just takes a blinkered approach to stats. So a good example of it, there was an article I read recently where it said that the new home bills are down by 8% since the beginning of this year. But when you look at it in that snapshot, that's actually true. But looking at it from a holistic point of view, we have some circa 237 new bills that are happening this year, which is 8% down from beginning of this year. So approvals are down by 8%. But last year we had 187. So there's still a huge upswing. And when you look at it from the last 18 years, it's the highest number of new bills that we've done.
It's a building boom.
Yeah,
100%. Right. And I think you're 100% right, is that the media tends to take a half-truth or take a certain bit of data or a certain bit of information and not tell the whole story around it, but whatever's going to sell the story.
It's a headline. I even saw it last night when I was watching the news, I think, and it had a promo for what's on tonight, right? So that was Sunday. We're recording on a Monday, and it said, it was like Today Tonight or one of those shows, and it said that this house here in Balmain, the markets are falling rapidly. A year ago, this house was sold for, say, $1 million. It's just resold today for $900,000. It's down by $100,000. Markets are collapsing. Little did they know that over the last 10 years, property in Balmain has rocketed at 100+% growth, right? So this is it. This is the attitude that you need to have. Just, choose your data sets
that's right.
correctly, because you're just painting a picture of being a building boom right now rather than, yes, it's down a little bit from earlier this year. So this is the headspace you need to get in.
And I think one of the things that we did consciously as investors is we exited out of the Sydney market 2 years ago. And 3 years ago, yeah. And the whole reason for doing that was to mitigate against this sliding back.
The contraction.
The 20% odd. And now it is time as markets change and the yields start going up and the vendors become a lot more negotiable because there's less buyers in the market.
Yeah.
And what we call the giggle money goes out of the market. We are able to then jump back in and be very selective on the properties that we buy so that we're buying based on today's fundamentals, not what used to work 3 years ago, buying today's fundamentals and buying the properties that will actually further our portfolio rather than dragging it back. So we're not buying your $1 million home that goes back to 900. We're buying the 900 that will go back up to $1 million as an example.
Yeah, and I think that's an important point because we did cop a lot of flack, say 3 years ago when we exited the Sydney market, but it was for that very reason because there would be that small or large, depending on where you are, contraction back to normality or back to the averages, so to speak. But you won't experience that unless you've experienced it. And by that, I mean gone through several markets or a dozen markets or whatever it may be, because often this is history repeating itself.
Yeah. If you just dressed differently.
Exactly. And perhaps, the media reports it a little differently. Like it wasn't, 12 months ago, the media were all about...
property's booming.
Yeah, property's booming. And someone flicked the switch and, well, we're the bipolar opposite.
Here we are. Well, I had a good chat with Dr. Andrew Wilson the other day, who you both know, and he pretty much said to me, what you guys are saying, that is, this is the market. Normality. There's nothing abnormal about where we are right now. This is just the way it is, and get used to it and look at how you can best capitalize on it. But he said, and I'm sort of paraphrasing this, but it's the death of the hotspot. And it made me think about that, what you were just saying, Victor, that the right places to invest is going to depend on who you are, what you're doing, where you are in your portfolio cycle, whether you're a new investor, whether you've got a big property. So this whole hotspot idea is largely redundant. What's your call on that?
Look, one of the most common questions we get asked is, which suburbs should I buy in to make money? There is no one answer because for each person it is really different because it depends on their financial circumstances, depends on how many properties they own, how they derive their income. And then once you've answered all of those questions and what you're trying to achieve, then the question arises as to which suburb and then which property in that suburb.
How do you work it out though? There's so many different moving parts.
Yeah, it is.
Yeah.
And the easiest way is to, again, as we began, get some clarity around what you're trying to achieve so that you're not just going out there buying a property. That's what most people do, is they are investing by osmosis, in the sense that they see and hear other people invest in a particular area and they jump in. Whereas what we do is we sit down and we map out a plan to see what it's going to look like in 1 year, 2 years, 5 years and 10 years in terms of the portfolio, in terms of the cash flow. Are there any life events that are about to happen? Are you going to have a change in your employment structure? And then we reverse engineer to say, this is what you need to buy right now, based on a cash flow, based on the amount of capital that you've got, and based on what the bank's willing to lend you and at what rate.
So what you're talking there is a big difference between a buyer's agent and I guess a property strategist.
That's right.
Yeah, okay.
That's right.
So that's the sophistication of how it's an asset, but how it fits within your wider goals, your strategies, your life, everything. And I think that's where a lot of people get a little bit confused. They actually go and buy a property rather than secure an asset that's going to help them achieve some long-term goal.
That's right. Property is just a vehicle, right? So we need clarity around what we're trying to achieve and using property as a vehicle. What a lot of people get wrong is once they bought 1 or 2 properties and they've had a few wins, especially if you bought in Sydney and Melbourne in the last couple of years, they think that it's repeatable and they continue doing the same. They haven't tacked and changed for where the market is, where the finance market is, and indeed where the changing landscape for their own personal finances is, because now they own 2 properties as an example, and that has significantly changed their financial landscape from where they began. So we need to adjust it to that, and then adjust it to the type of property in terms of complementing the first 2, and also adjusting it for, in the case of Sydney, a weakening market. So we're starting to flatline, and then looking at, do we invest here? Do we do some land banking elsewhere, or do we not invest at all for the immediate future?
So we're talking about the psychology of being a good property investor, and this is the stuff I think about all the time that you guys are saying, and the work you do with your clients. But let's talk about the psychology of the wider market. So, Steve, what's the headspace at the moment of agents in this market? And I guess I'll preface that because I always ask you guys this question: are you getting more calls from agents than you're calling agents, right? Now, it always gives you a bit of an idea of their headspace at the moment, where the market sits. Are the agents starting to pick up the phone to you guys saying, hey, I've got a great off-market offer for you?
Depends where.
Okay.
And as we've talked about before, that's a really good indicator or barometer of that particular market. So Sydney agents are calling for sure.
Okay.
Even those that we haven't spoke to in a couple of years.
Are they friendly? Are they, Steve, how you going?
Yeah, long time.
Yeah.
It's so that's quite the norm now. But the volume of calls is different in each LGA.
Yeah.
Brisbane,
local government area.
Yeah. Thank you.
Yeah.
Brisbane, quite the opposite. Yeah, it's the agents don't call back. Well, they don't initiate the call, that's for sure. So it's a matter of us being relationship orientated, I suppose, and doing anything that it takes to keep that relationship. Melbourne, they're starting to call.
Okay.
Adelaide, they don't call. We have to call certain parts, of course. Canberra, pretty much the same thing. And where else is there? WA. So WA is...
It's a strange
mixed bag.
one.
Yeah, it's a mixed bag. There are...
Depending where you are, right? It's
very much. Yeah. But they are a different type of agent as well, as opposed to the East Coast, a little bit, perhaps some would say more relaxed more relaxed. But certain parts of Perth in particular are still buoyant. This flies in the opposite of what the data suggests. I saw Damien Collins, REWA's new president, give us some good data sets the other day, and it's trending upwards in terms of vacancy rates, or downwards, I should say, but rents are going up. That doesn't mean it's a blanket approach, because it is an average and it is a data set, but there are certain little pockets there where days on market, I would suggest, are probably lower than some areas of Sydney, and the flow of blood has stopped. So there's green shoots there. Yeah,
and we're talking about getting in the right headspace for investing, and there are these different participants as part of the property ecosystem. You've got investors, us, buyers agents, you have real estate agents, you have property managers, you have all and sundry. Everyone's works within his ecosystem and it finds its own way, but then you get all these different things thrown into it. And one thing which is going to start headlining now, that as an investor, to get your head straight and keep your psychology positive, is potential federal election, which is going to be pulled early. You know, we've just gone through a weekend where the Liberal Party's lost their Wentworth seat. We don't yet know exactly if that's going to be the case. There's a whole bunch of postal votes coming in, and there's still a lot of noise around it. But it looks like they've lost it, right? With the preference votes.
Not that you want to hope so, but Phelps would want to hope so, seeing that she called it early.
Yeah, you think so, right?
Yeah.
But either way, there's going to be a lot of pressure on the government to call an earlier election if they've lost, a majority parliament. So this is going to dominate headlines moving forward. Victor, would it just know what's going on, but don't get too absorbed by it all? Would that be your recommendation?
Don't get too absorbed. I think what'll happen is you've got a double whammy happening, right? So we're moving into the Christmas season, the silly season.
Yep.
So people get more into your office parties and all that rather than having enough time to invest in their own future. And also with all this rhetoric about your negative gearing and the platform that the parties are using and so forth, and tinkering with capital gains tax as well. So it will certainly stop quite a few investors that are not as clued up. And now more than ever, not giving myself a plug, but now more than ever, you should really get some professional advice and professional guidance to shut out the noise and concentrate in the areas that does make sense. But it also, what it'll do, it'll open up the market a little bit more for the investors because there's less people buying. So it'll tip back towards being a buyer's market and a seller's market in most states.
And let's be clear, as an investor, that's what you want, isn't
Exactly.
it? You want to have the upper hand. So it just happens to be the Christmas period that we're entering, and
we've landed some great deals around Chrissy.
Yeah,
it's a
we all
great
have.
time to buy.
We love it. And I think going back to the earlier statement from Andrew Wilson saying this is the new norm. It's actually not the new norm. It's the old norm.
Yeah,
it's the old norm that's just brought back. Yeah, exactly. And let's be real here. Everything else is normal. In fact, good. So we've got consumer confidence index is up. We've got jobless rate that's down with 5%, 5.3 month before or whatever it was. We've got green shoots of wages growth.
Yep.
That's all good news. That's all good stories. And especially the consumer confidence index. For me, that's a, and we've talked about that before. It's one of the things we look at within certain areas as to whether we should be investing there amongst a plethora of other factors. But it's up.
Well, people are spending. I saw Jerry Harvey on the telly the other day, and he's talking about, we're still growing. People are still buying.
Well, of course he is.
Everything.
Yeah.
Do you want a store card? Obviously.
But there's just so much other good news out there that people need to sort the wheat from the chaff and just not focus on the negative stuff, which is human nature.
Yeah.
And just go forward. Business as usual.
So, Victor, what are we trying to achieve with this particular conversation? We're talking about the psychology of investing. So get yourself into the right zone to make the right decisions. How do we do that? How do we get people to change their perception or their paradigm right now? Or do you think some people aren't going to be able to change and that's just the way it is, but the good ones will?
Yeah, the good ones will. Some people, that's the way they're wired, right? So if there's a lot of noise, they get attracted more to the noise than the fundamentals.
Yeah.
I think a little bit more of education and talking to the right people that have been through this multiple cycles, to be able to give you pertinent advice and pertinent recommendation as to what to do in your portfolio, whether it is to not buy anymore or whether it is to change what you're buying, or dare I say, maybe sell down one or two to cash up and relook at different areas. So if it's gone through its peak and you're seeing that the trend previously has been that it'll flatline for 10 years as an example, maybe it is time to offload that particular property and get into another growth area to continue building your portfolio. Now, obviously, when you sell, you trigger a tax event, which is capital gains tax, and you lose the future growth potential. But if that's what your plan is in terms of the bigger picture, perhaps that's what you need to do. And then the trick is to obviously use the loan portability. So in other words, don't discharge the loan. Use the loan portability to buy a similar priced property in another growth area and then ride that wave up.
And that may depend on the area as well. So if it's perhaps a semi-regional area, depending on what state you're in and how they, what they call regional. It may be, or it may have experienced humongous growth over the last 3 years and perhaps done 10 years worth of growth in 3. It's an older house, lower yield. Well, it might pay dividends to actually cash that, take the profit, move it elsewhere or build a buffer, whatever it may be. But I think people really need to do the numbers if they're going to sell out of a major metro area, like a Sydney area or a CBD, because the cost associated with getting out and then getting back in the future might erode profitability.
And certainly talk with your accountant well before you actually put it on market or anything like that, because it does have major tax consequences as well.
It does, and I think they're really good points to cash out and take some money off the table. There's nothing wrong with that. If it suits your strategy and you're going to, look, you might use that money to go on a family holiday, and that's it's good for your personal enjoyment. That's cool. But you want to be looking at where you can replace that to make sure you get the same growth out of it.
Well, I think the big thing for me is, and if the listener could really get their head around this, is that money needs to be working for you all the time. Yeah. So if it's in your offset, saving yourself 5%, it's working. If it's sitting in a 1% savings account, it's actually going backwards in value. If you've leveraged it to buy property, shares, or some other investment vehicle, it's working for you. It should never be lazy because it is actually going backwards.
Yeah. And everyone's always going, this all sounds really good, guys. You know, I've got the right headspace. I want to keep growing my portfolio. Yes, we're moving to a buyer's market in some areas. But what's going to happen with Sydney and Melbourne is what everyone's thinking, right? Because these are our major capital cities. They're global cities, right? You know, we've gone through this a lot before on Investing Insights with the Right Property Group, and go back and listen to all those different podcasts which look at the fundamentals of the Sydney and Melbourne markets. And that's not saying other areas in Australia isn't worth investing in. You know, we all invest in.
But that's the barometer.
That's barometer. And on the telly again, I don't really watch a lot of telly, but it feels like I watched it last night. I saw, maybe it was on the weekend, John McGrath coming out talking about the fundamentals of the city market and how, I can't remember what they called it, but there's the belt of property from Penrith, Liverpool, Campbelltown, which is where all of our infrastructure is being spent out there. You've got obviously Badger's Creek out that way as well, but you just got to drive anywhere in Sydney right now and there's roadworks going on or there's train lines getting built. There's a lot happening right now.
We're in the midst of an infrastructure boom.
And that's not happening in this area where we're recording in North Sydney. That's happening out in the western suburbs where I think a fifth of all mortgage holders in Australia are.
Which is an important fact that people tend to forget.
It is. So, you know, let's talk about some specifics because I know we've got to wind up, but people are going to want this. Victor, you love the western suburbs.
Absolutely, I do.
When's it going to be time to start buying out there again? Or are you already doing it?
Look, I'm already putting my feelers out.
Okay,
I haven't bought this year in the West. In fact, I haven't bought in the last 2.5 years in the Western Sydney market. But certainly I'm putting the feelers out because I'm actually seeing...
What does that mean though, putting your feelers out?
Getting back in the market and making it second nature, because I've been out of the market in a substantial way for the last 2.5-3 years, and small things change, right? You go down one street and you may not have noticed a group of townhouses that are there now, which changes the streetscape there and changes the micro demographic in that particular street. So we need to look at it from that viewpoint. We also need to look at what does it really mean in terms of the infrastructure, and so that you can divorce yourself from the media noise. In other words, a lot of the property pundits getting on the bandwagon and saying it's going to go up, it's going to go up. We're going to take a leaf out of the Perth market. Perth market, most of the pundits were saying since 2011 that it was going to go up, it's going to go up, right? But the fundamentals weren't there. I believe the fundamentals are here in Sydney, but I don't think we've quite turned the corner in the sense that it hasn't quite flattened out yet, in my opinion. Certainly.
How do you know? So do you watch prices, sell prices?
I certainly do, yeah.
You benchmark it against other... Okay.
So I do the equivalent of paper trading on properties in itself. So we follow properties through to settlement and see how many discounts they've had, how many inquiries they've had. So I earmark particular properties and then follow it all the way through to settlement and then tenancy as well, because it gives you a good gauge so that you're not just looking at a property that was inflated to begin with and they've discounted it to where market was and then it's sold. You need to actually see true discounting happening in that sense. So that
real time, not data sets 3 months old.
That's right.
Yeah. And Steve, Melbourne, it's a slightly different market than Sydney, but some parallels.
Yeah, I think the Sydney market certainly started to contract well earlier than what Melbourne did. So I think Melbourne's still got a time to go. Yeah, the pockets within pockets. Some of the regional areas in Melbourne are still doing quite strongly.
Yep.
But just back to Sydney for a minute, I think, well, and Melbourne for that matter, any area, but especially in Sydney and Melbourne, it's all good to say, well, I think the market is flattening out as an example, but what everybody needs to do is actually look into those particular council areas and see how much construction is still underway, because whilst the market may have flattened momentarily, there might be a heap of house and land or apartments or townhouses that come onto their market, and it's almost like a false dead cat bounce, and so the market, it's solidified, stop going backwards, and then we get this second rush of accommodation. So it's looking actually probably 12 months ahead in terms of construction and what have you, to see what's going to be released, as well as what sort of funnels of population growth are being fed into the area. So as immigration still strong, council areas change to play with the numbers in terms of population growth and areas, what have you. So there's a lot into it, rather than, well, let's just sort of lick our finger and put it up in the air and see which way the wind's blowing from.
And the only way to truly find this out is to be actually on the ground physically, and talk to the agents, go through the shopping centres, look at the sites that are being developed as to whether it's a hive of activity or whether it's actually slowing down. The development's actually slowing down. You can't get that off a desktop. You have to actually be physically on the ground.
No, and the market, I think initially, or for us anyway, the initial purchases in a market that perhaps has reached bottom are usually around the renovation pieces.
Yeah, absolutely.
Because something that's already cosmetically challenged to a smaller buyer pool, and especially with today's lending environment being so hard, we can usually negotiate better, so make the money on the way in more of, and the renovation is just there to accentuate its value, so to speak. So that's usually the initial point.
Okay. I think we've done pretty well today. Psychology of investing and how to be a good investor. Victor, can you summarise it for me in a couple of paragraphs?
Paragraphs?
Yes.
I'll write you a letter, Phil. How's that?
No. Come on. Just in the market, today's market and tomorrow's market, how can you actually get your head straight and do the right things?
Okay. The first most important thing is to cut out the noise. Yeah, stop following these negative media stories. And look at the data in its entirety and see what truth it reveals, rather than a small snippet of data being taken and then bandied around as being the truth. Once you've done that, then you can look at what your borrowing capacity is, your lending capacity, and adjust your portfolio accordingly. And don't be shy to put your hand up and seek some expert help with people that have actually gone through it themselves, people that have been around for more than one property cycle.
And Steve, you've painted a good picture there with some numbers around sentiments and job growth, wage growth, etc. Anything to add to that, just to close with?
I would say attack the household budget, see what surplus income you can trap. Because no matter how good or bad the market is doing, if you haven't got the surplus income to be able to invest, well, you just shouldn't be investing. Yeah. And get the house in order, I would imagine. Try to separate, as Victor said, perhaps the sensational news and fake news versus what's reality, because there's a bit of both. And if you're in a position to invest because that's what you do, well, then you should invest. And if you can't sleep at night, then don't invest.
It's good counsel. Gents, thanks for that. Really enjoy the chat. Victor, if anyone wants more information about what you guys are doing, where do they go?
Sure. Go to our website, rightpropertygroup.com.au, RIGHT, or like our Facebook page, Right Property Group, and you should get all the news there is.
And if you do want more education around what we're talking about, on the website there's over 150 different
blogs.
Blogs and vlogs, I think they call them, is the new way to say it.
Video blogs.
Yeah. And some educational pieces there. So it's all there for free.
Thanks for joining us, everyone. We'll be back again next time. Until then, bye-bye.